is a belief that toward the end of the year, supply markets will balance.
We are seeing evidence that tail risk is reducing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. It is Jobs Day. The usual great guests will join us. Jeff Rosenberg to join here in a bit. Randall Krosner, the former governor of the Fed. And John, guess what? It's not a normal Jobs Day. We have 5, 6, 7% inflation.
In Europe and in the United States as well, Tom. As for the payrolls report, put a blindfold on and throw a dart because the range is super wide. Once again, from 0 all the way up to 700K. The median, 490,000. The number drops in 30 minutes.
Within your reading, John, can we say this Jobs Day could adapt or adjust Fed policy? I'm not there.
I think, Tom, for the 50 basis point move in early May, this is a jobs report that needs to tell the Fed not to, rather than tell them why they should. I think they're already there. 50 basis points, the whole of Wall Street getting behind that view.
We'll speak to the White House here in moments. And, I just say, Lisa, that the political backdrop of this jobs report is seen in a gallon of gas, but really now percolating into all the inflation of America. It's a different labor economy.
Yeah, the conversation this morning is about the very hot labor market, all this good news that we're hearing out of the economic data, and then the sentiment of consumers, which is low and lower, and it's because of gas prices. It's because of the inflation. How do you respond to that at a time where it still isn't materially crimping consumer demand enough to be a self-fulfilling cycle?
In the first quarter, Apple Computer 178, and at the end of the quarter, 178. I guess it was a boring quarter, John. Let's do the data now to get to our esteemed guest, but it's simple, John. What an odd quarter for equities.
And ending with a massive month of gains as well for some of those names, Tom, including Apple. Equity futures up 0.4 on the S&P, on the Nasdaq 100 up 0.5%. Yields higher by 6 basis points. What's the spread now, Tom, between 2s and 10s?
2 beeps.
2 basis points. 30 minutes away from your payrolls report. Crude lower, Tom, 98.82 on WTI. We're down by 1.48%.
Ira Jersey to join us later with Gina Martin Adams. And again, Randall Krosner will join us here with perspective on the greater economy and this labor economy. But first, we need to look at that $6 gallon of gas in Mammoth Mountain, California. And yeah, it's cheaper other places, but it is front and center for President Biden. Joining us, a gentleman hugely qualified on this strange word, energy security. Amos Hochstein is Senior Advisor of Energy Security at the Department of State and joins us today. The thing here, Amos, every time around is whip inflation now. And every president has a different path, like Jerry Ford, to whip inflation now. And your reading of history is the same as mine. This is a tough task. What is the first order of business for Joe Biden?
Well, I think, first of all, good morning, and thank you for having me on the show. As you said before, energy security is a critical issue, and I think the president took strong steps yesterday to address the fallout in the energy markets as a direct result of the Ukraine war and the invasion, the unjust invasion and brutal war that Putin is waging in Ukraine. And that has consequences, as the president said yesterday, here at home with rising costs of energy, rising costs of oil, which, of course, translates, as you said, into rising costs of gasoline for Americans. So President Biden took a strong step yesterday, announcing the largest SPR release, the Strategic Petroleum Reserves, 1 million barrels a day for the next 6 months. And that we've already seen prices come down as a result of that announcement. That's going to have a major impact in the oil markets and the energy markets at large.
Yeah, okay. But Amos, what's important here, and this is pizza security. John, this filters down into every product, including a slice of pizza at Famiglia in New York. It is up, up, up.
You're very delicate about the slice of pizza in New York, Tom.
I think it's as important as a gallon of gas.
I agree it's important. There's another measure, Amos, that you announced yesterday. You called on Congress to do something, to make companies pay fees on wells from their leases that they haven't used in years, and on acres of public lands that they are hoarding without producing. That's from the statement from the White House released yesterday. The administration keeps talking about these 9,000 leases. Amos, I don't think if you wrote this, you would have written that. Because if I asked you the following question, I want a direct answer to a direct question. Of those 9,000 leases, how many of those sit on productive land?
So I will answer you a direct answer, but let me just say on slice of pizza price, I agree. the prices are going up everywhere. Part of that is as a result of these skyrocketing energy prices, where we're not a farm to table economy, we're a farm to truck to table. So everything that we consume has to go on, has resulted in a gallon of gasoline or a gallon of diesel, trucks coming, crisscrossing the country for delivering, whether it's ingredients for pizza or if it's for other commodities. So there's a direct result, and that's why it's not just the gallon of gasoline is not a political issue. This is a real economic issue that we need to address, and that is a result of a foreign war that we have to be cognizant of. As far as the leases, look, these are on public lands, and your point is right. If some of these leases are on non-productive acreage, then the companies that are holding these leases for several years sometimes and are not doing any seismic, not doing the kind of work that needs to be done on that acreage because they think it's non-productive, then you have two choices. Either you can return the lease or give it up, or you can simply pay the higher fees because you want to hold on to that lease for a little longer so that you can develop it later. And I think that is, I would have written that.
But Amos, you know why they might want to sit on it and develop it later? It could be on third-rate land that requires a higher crude price. You know how this works. The way this is being framed by the administration is that these land leases are being hoarded, that we're sitting on productive land and it's not being produced because these companies are greedy. I mean, I'll read the line out from the president. His words. Companies have an obligation that goes beyond just the shareholders to their customers, their communities and their country. No American company should take advantage of a pandemic or Putin to enrich themselves at the expense of American families. What evidence is there that they're hoarding those leases? Wait, I'll finish, then you can go and I'll give you all the time you need. What evidence is there that they're hoarding those leases because they're being greedy to profit from what's happening in Ukraine?
So let's disaggregate. There are a number of issues here. And the president actually recognized the companies, the oil companies, that are responding to this price environment, that are responding to this world supply shortage that we're in, and have announced extraordinary increases in CapEx and in reinvestment in the United States in bringing on additional production. And he's recognized them and said that is progress, and he praised them for doing that. But there are other companies, and you know that, Jonathan, that are saying, look, I have the ability to increase production with prices when prices were at 120 and 130 just a week ago, and said, I'm not going to do it. And he called out some of those who've said, even at $200 or $300 a barrel, I'm not going to increase production because a variety of reasons. And some of them are saying, the funds that back me or that own are my shareholders or my holders of my debt are saying, don't do that. Give us increased dividends during this time. There is no well that is not profitable at 120, at 130. And if you're making a decision at prolonged period of time of above $85, which we've now been in for a few months, that you can't make more investment to bring on production, then I think the president is 100% right to call them out, especially when other companies are saying, no, this is exactly the kind of environment that we are going to increase production. And look, we did two things. One, the president announced that we're going to release 1 million barrels a day in order to increase the certainty of liquidity in the energy markets and to make sure there's enough oil on the market to support the U.S. economy as well as the global economy. Number two, he has said that we're going to replenish the reserve at a time when we finish dispersing and releasing the oil and when prices come down. So we're going to sell the oil now at high prices, buy it back later. That gives incentive to the oil companies to say, look, I know that even though the U.S. is going to release these reserves, I'm going to have a buyer in the U.S. government later on. So it continues that incentive to increase production. And I think that this is what we needed. We needed to put something into the system where we can bridge. The oil companies have said, if you look at Exxon and Chevron, Conoco, Oxy, have said they're going to increase production. We're going to increase 900,000 to 1 million barrels a day this year. And that means, but it's only going to come on in the middle of the third quarter to the end of the year. So we have a gap between now and that period of time. So what the president did yesterday, this historic move, is to say, the U.S. government's going to fill that gap. between now and then, and put that same 1 million barrels a day of production that we were hoping to get at the end, that we're going to get at the end of the year, and put that out now, so that we're not replacing the private sector, we're incentivizing it and letting the American consumer benefit from lower prices between now and then.
The likes of Goldman Sachs disagree. Jeff Curry says this: the US policy use of an SPR release, a potential deal with Iran, extreme price volatility, and the growing risk of a recession next year are all exacerbating the uncertainty faced by producers, reducing their incentive to invest more. Amos, the reason I bring this stuff up is that I want to avoid this really kind of simplistic conversation that something untoward is happening in the oil patch, when you know that what happens in the oil industry is incredibly complex. Now, you've said something else over the last few years as well, over the last 12 months. I'll bring up another thing. This was November 17th. President Biden urged the FTC Commission chair to investigate oil and gas companies' retail prices, blaming industry leaders as gas prices continue to soar. It's become this talking point that oil majors are hoarding these leases, even though you admit we don't know what's on that acreage. We don't know what's on that acreage. Then there's this other talking point that somehow these companies are price gouging, and in the president's words, taking advantage of a pandemic or Putin to enrich themselves at the expense of American families. I'm just asking, what evidence is there of that? You wanted to start this probe. What have you found? What evidence is there? What companies are price gouging right now? And if you can identify them and name them, what are you doing about it?
Well, first, I think, as we said yesterday, I don't believe, first of all, to Mr. Curry's comments, I and my colleagues in the U.S. government, we've been in close contact with the energy industry. And most companies have actually said that they believe what we did yesterday was exactly the right thing to do. And that they feel that it has an incentive because it is for 6 months before their production comes online. And because we're going to spend the next couple of years replenishing the reserve, that means that they are incentivized to continue to spend the capex that they've announced to increase production. So with respect to Goldman Sachs, and I take a lot of issue with some of the other things that he said in that report.
Well, I've no doubt you do. But another question you'd be asked as well, Amos, is who would make a decision like this to boost capex on front month Brent futures? Who would do that? WTI futures front month. Who would do that? You know what the rest of the curve looks like. Why would they make a decision based on where the front month is?
Well, Don, I got to tell you, they are making that decision. They have announced that they're going to, several of the majors who are the largest holders and drillers in the Permian and in other shale basins have said that they are increasing capex. I think Exxon said 25%. They're going to increase production. Total U.S. production is going to grow by about 10% by that 900,000 to 1 million barrels. It's just that these things don't happen overnight. You know that the decision to spend money, billions of dollars to bring up production, doesn't mean production comes on the next day. But I want to address the point that you said, because I think the president was very clear. We're not taking a broad swipe of the whole industry. He said he wanted to acknowledge the fact that part of the industry has done exactly what it needs to do, and to see high oil prices, incentivizing them to bring about more production. Other companies, and we can't ignore this, Jonathan.
Yeah.
Some companies have said, and the quote that he used in his speech, that even at $200 a barrel, I will not increase production because of so-called fiscal discipline. That is not, I'm not making that up.
No, I know you're not. Amos, to be fair to you, just let me jump in. To be fair to you, that was a comment on this network. I heard it. I talked about it. I repeated it. It's something I've said before. Another thing I've highlighted as well was a Wall Street Journal report that came out in the last few weeks. The administration is trying to make a call to the Saudis in Riyadh, trying to arrange a call with the Crown Prince Mohammed bin Salman, and they won't take the call. Now, I spoke to a member of OPEC, and you can respond to that in a moment. I spoke to a member of OPEC this week, and I thought it was utterly embarrassing for them that they had a meeting earlier this month that lasted 13 minutes, and one just yesterday that was at 1 minute shorter. Now, I wonder if it's more embarrassing for us that they're laughing in our faces and doing this. Now, you speak to the Saudis. Talk to me about it. A, is that false? Did the administration try and arrange a call with Crown Prince Mohammed bin Salman and the President of the United States? And B, why are their meetings lasting 13 minutes if we're in a massive energy crisis?
So, one, there was a call that was going to be arranged between the president and King Salman, and that call did take place. Those reports, I'm seeing constantly reports of Saudis snubbing the U.S., or I think there's an interest in certain quarters to bring about this kind of narrative that is completely false. I've been to Saudi Arabia on a number of occasions over the last several weeks, or a couple of months. On a couple of occasions, I was told what the Saudis told me on the front pages of a U.S. newspaper about 3 hours before the meeting started. And I showed the Saudis the headline so that we can jointly comment about the hyperbole of the press on this. So I would really relax. I don't think there's the relationship between the United States and Saudi is strategic. We have a lot of issues that we need to work on together. There are complexities in that relationship that we are working on. We have a lot of issues that are of common interest, fighting terrorism, that Saudi has had to suffer through over the last several weeks, specifically from the Houthis. We have a lot of strategic interests elsewhere in the region, and as well on energy. And I'll tell you that we're having very good discussions there. The press and reality on this one are really far apart. On OPEC, look, I was asked before the OPEC meeting if we had a message to OPEC, and my answer was, I have no message for OPEC. These are folks that know the industry, they know the market, they know the supply and demand. I must have a difference of opinion. We believe that, not just believe, but I can see the physical evidence that the market is short about 2 million barrels a day, if not more, from Russian supplies into the global market. That is clear to me. We can see that. Obviously, some perhaps in OPEC don't see the shortage of supply, but I can understand that it's a complex issue for them with the OPEC versus OPEC plus. I think that's they're going to have to take some time, and perhaps if you're not going to discuss the issues very seriously, perhaps 11 or 12 minutes is all you need. But at the end of the day, they've done what they needed to do, and they've increased production announced that they're going to continue the increases of production. We don't think that's right. The president is not asking other people to do the work that we should do. He took action yesterday by himself on behalf of the U.S. government for the American public of releasing 1 million barrels a day. I believe, by the way, Jonathan, that we're going to have additional capacity coming online from our allies. And the president coordinated this release, as he has all other measures against President Putin, with our allies when he was in meetings at the G7 and the NATO summit last week. He's discussed it with leaders even earlier this week. I've had conversations with my counterparts, and there's a meeting that is going on right now of the IEA, the International Energy Agency, to look at additional releases from the international market. So we won't just have oil coming on the market in the United States, but rather have oil coming online into the market in Asia and as well as Europe over the next several months.
Amos, you're a professional. You've given us tons of time, and that's valuable to me. You know that. Thank you very much. I appreciate it. Amos Hochstein there of the U.S. administration on the situation right now. And Tom, it's a complex, nuanced conversation.
It is complex, but every single oil pro really pushes back against the idea it's easy to boost production. There are huge reality constraints within the Middle West of this nation on labor, on concrete, on steel pipe, and on the tangible stuff that you actually have to do at the margin.
The Payrolls Report, Tom, 12 minutes away.
Payrolls Report, 12 minutes away. Randall Crosner will join us. But first, Nadia Lovell, too short a visit with UBS, I should say, their senior U.S. equity strategist. Nadia, Office Jobs Report is a reality of an inflation study. What do equities do within higher inflation?
I think the equity markets will be choppy going forward from here. Of course, everyone is watching the inflation numbers. We are expecting inflation to peak in the next month or so. For March, we're looking for 8.5% for CPI, and then we're looking for some moderation to 6.5% for April. And so a lot of this will depend on where commodity prices go, but also we are closely watching what the Fed is going to do right now. We're looking for rates to be front-end loaded. We're looking looking for 50 basis points in May as well as June, and then a return to a 25 basis points cadence. And so we think that the market can be able to weather that storm.
Nadia, we just heard from Amos Hochstein of the State Department talking about oil prices and how that's feeding into consumer spending power. How much does that play out in the expected earnings reports that we're going to get within the next few weeks? How much deterioration do you expect in the margins?
That's something that we're watching very closely. We have seen that the resiliency of margins the last couple of earnings seasons, company has been really able to pass along those costs. So we've been listening very closely to hear if they're hitting any resistance level. We think that is going to vary. You know, in the last couple of weeks, we've seen airlines lift their guidance on strong demand despite the higher fuel prices. We've heard a similar tones from the lodging and gaming companies. You know, through this week, we also heard from a luxury home retailer demand has softened owing to the war, and so there might be some shifting of sentiments, but this might be also further indication that spending is shifting away from goods and towards services. So there's some mixed signals, and so we'll be watching very closely at the earnings season to reconcile some of these differences and also to see where margins are going to go. But near term, we think margins will be able to hold up.
Do you think that stocks have gotten too concerned about rate hikes or not concerned enough, as a lot of people talk about this dissonance between bonds and stocks and what they're pricing in terms of Fed action?
So you've seen a repricing of risk assets, of course, this year. We've seen the valuation multiple for equities come down from 29.5 times back in November to about 19.5 times today. So we think that's fair. We think that the reaction that the market has is fair in that repricing. In terms of what's going on in the bond markets, you know, obviously the 2-10 spread inverted yesterday. And so, but we do think that that's sending somewhat of a false signal. We know that inverted yield curve tend to precede recession. It has done so in the last 8 recessions, but it isn't great at predicting timing of the recession. Usually it takes about a lead time about 15 months. And so we think the predictability power of the curve in this cycle is not as good. It's more important, we think, to look at the 10-year, 3 months, which is a better indicator that we're watching very closely.
2s10s right now, just short of 2 basis points. Nadia, thank you. Nadia Lovell there of UBS. Tom, futures going into this one, up 0.5% on the S&P, and the bond market yields are higher on 10s by 6 basis points, just short of 240.
And 2s10s still knew that flattening here, 0.93 on 2s10s this morning. This is a joy because it is a symbol of the end of this pandemic. The University of Chicago Booth School celebrating the opening of their London platform built during a pandemic with the leadership of Randall Krosner. He's a former Fed governor and, of course, professor at Booth. Randy, it is a sign of a pandemic opening. We just spoke to Amos Hochstein of the White House, of the State Department on energy. How much of the mystery of this second quarter is about a booming nominal GDP and a booming American economy?
I think you really nailed it there, because the key issue is how much demand is there going to be that's going to be driving price pressures, given all the supply constraints that we have in the world. We have the ones from the pandemic, and now with the war in the Ukraine and sanctions, that's only increasing the supply tightness. And so that's exactly the issue that the Fed is going to be facing.
And what they face, Governor Krosner, is the idea of moving from 14.5% nominal GDP down to, let's call it 5 or 6-ish. I don't want to do your job. And I guess the game is to get nominal back to 4 or 5%. Good luck with that. How does the Fed's job change given substantial combination of real economic growth and inflation? It's different, isn't it?
Yeah, this is really the biggest challenge that they've had in decades, because, as you know, we were at 40-year highs in inflation. The economy is still going pretty strong because of the pent-up demand from the lockdowns and from the pandemic. But they need to raise rates, and they are going to be raising rates. The concern is that did they wait a little bit too long, and now they have to move higher quicker than they otherwise would like, which potentially could slow things down in the second half of the year or next year. It's a pretty tough trade-off that they have.
So which would you prefer, Randy? If we had this binary choice of either allowing inflation to run a lot hotter or having a bigger risk of recession, which side would you err on?
they've got to rein in the inflation. And so hopefully they can do that in a gentle way, and I think they'll be cognizant of what the consequences of the war are, what the consequences are of other shocks in the real economy. But we saw what happened in the late 1970s. We don't want to have to raise rates to double-digit levels in order to try to bring in inflation, because inflation expectations have gotten out of control. Fortunately, they haven't so far. One of the reasons that the yield curve is so flat is because the 10-year is signaling we don't have that much of an expectation of high inflation. Same thing with the Treasury tips. But that's that's something that's quite fragile, and that could move up quickly. And so the Fed needs to act sooner to make it less likely that they have a recession.
Randy, we're about less than 5 minutes away from the jobs, the payrolls figure for the month of March. Are there numbers that could actually get the Fed's attention and cause them to move even faster, or what numbers would actually move the dial in this front?
I think one of the things that we'll be looking at is what's happening with wages, but I don't think there's going to be enough to move the dial on that. Certainly, they'll be looking at labor force participation and the employment population ratio, which has been moving back up after falling precipitously during the pandemic. Mm-hmm. So we're starting to get more people back into the labor market, which is a good thing. And part of that is because some of the savings are starting to come down. We sent out checks to an enormous number of people. They're starting to spend that. That's coming down, and so some of those people are going to come back into the labor market.
Randy, you're going to be teaching all this in London, at London Booth or Booth London, whatever. I can't remember what the branding title is. Is any of what you did at the Fed in the textbooks you're going to use? I mean, we seem to be in such original place this Jobs Day.
So a little bit of it is some of what we had from the past in responding to the financial crisis and what the Fed did so the central banks in response to the pandemic. Some of that's in there, but this challenge of such strong growth, such high inflation, we really haven't seen that in a while. Some of that's there, but what's fun is I get to talk about some of the experiences from the time of the Fed, and it's really engaging with the students.
Randy, what would you do if you were looking at the balance sheet? We've had a lot of back and forth over how quickly they're going to reduce it. How does it play in this sphere?
So I think that's something that I think what they're going to do is want to run that in the background, much like the Fed did previously. They want to make the interest rate policy the main tool and the main thing that people focus on, and I think they'll gradually reduce the balance sheet. I don't think they're going to do anything shocking with that, partially because of all the uncertainty in the markets. I mean, look what happened in the nickel market and the London Metals Exchange. A lot of disruption there, a lot of potential for disruption on other markets. So we certainly don't, the Fed doesn't want to pull out too much liquidity too quickly.
John, that's pretty cool. The guy goes over to London for a cup of coffee, and he's quoting LME.
You know how that works.
You know.
There's just that London buzz.
More than a cup of coffee, Tom.
How long have you been there, Randy, now? How long have you been in London now?
I was in London 2.5 years. I'm actually back in Chicago now because we had the official opening. It was really great, and so I'm back in Chicago for a bit.
Very cool. Well, welcome back, Randy. Thank you. Randy Krosner there of University of Chicago Booth School. About 2 minutes away from payrolls, Tom. The estimate 490. Should we get it set up and go through the market? Futures positive about 0.5% on the S&P. On the Nasdaq up around about 0.5% as we kick off Q2, leaving Q1 behind. The first quarterly loss on the S&P 500 going back 2 years, believe it or not. Last month, though, pretty decent. The month of March, a decent month of gains on the S&P, even with this happening in the bond market. Yields higher again by 5 basis points on a 10-year to 239. And the move we've seen on the 2-year last month was huge. Up 90 basis points on the month, 160 basis points on the quarter, Tom. And this morning, yields pushing higher again on a 2-year, up 4 or 5 basis points to just short of 240, 238.
Anybody speaking with certitude out 90 days, John? Or out even 1 week, they're dreaming. All I can say is it is absolutely original that we've got 6 or 7% nominal GDP in America No one knows where we're heading right now. We can guess, but we don't know where we're going.
What people are feeling, though, Tom, is the 7% inflation number, pushing 8% and might go through it on April 12th. That's a similar story in Europe now, driven by energy prices. And Lisa, didn't that get your attention? Before we switch our attention to the US exclusively, in Europe, to have CPI 7.5%.
It's unheard of, especially after there was this big rally to try to get inflation up to 2%. Well, that kind of got blown past. At what point does this become a global phenomenon that feeds on itself, and how much can the consumer really take?
The jobs number is 22 seconds away. The range is wide, wide, wide. It always is. It's anywhere from 0 at Pantheon to 700k at Landesbank. That's the range. The median's 490k. The number drops in about 10 seconds. Going into it, futures up 0.5% on the Nasdaq, up 0.5% also. In the bond market, Treasury yields are higher to 238.95. With your jobs report, here's Mike McKee.
Good morning from Washington, John. And the numbers not quite as good as anticipated, but still strong. 431,000 jobs were restored. We're still in the restoration period, shall we say, during the month of March. And the unemployment rate drops further than we had anticipated, 3.6%. So the labor market remains very strong in the U.S. The payroll revision, 95,000. So add 95 to that 431,000. And you end up with over 500,000 over the last 2 months, which is very, very strong numbers. The only thing that we're not clear on is how that's going to affect the Fed, because with unemployment at 3.6%, average hourly earnings go up 5.6% on a year-over-year basis. That's a tick more than anticipated on the back of a 0.4 rise, just as forecast by economists in the month of March. The labor force participation rate goes up a tick to 62.4. That is what was anticipated. So more people coming out to look for work, more people getting jobs, and more people getting more money for those jobs. It's a good news story for the labor force, but maybe a bad news view on inflation.
Here's the first move in the bond market. Yields up just a little bit more. 2s, 10s down to a little less than 1 basis point. Let's whip through it. In the equity market, we stay elevated, up 0.5% on the S&P and on the Nasdaq 100. Let's call it 0.4% higher, up 8 basis points on a 10-year. Your 10-year right now, 241.89. Tom, the difference between 2s and 10s at the moment, a little less than half a basis point. I think we should just call it 0.
John, I got the old HP12C out here, and here's the number you got to focus on with a 95,000 revision. I believe the math is 526,000 with the constructive revision, and that again speaks to 3.6% unemployment rate. I mean, the numbers speak for themselves.
How about that unemployment rate? Mike McKee, speak to that and speak to what the Fed is expecting this year and next, because their number for year end's 3.5, I think, for the next couple of years.
Yeah, the Fed is expecting 3.5% once we get there this year, next year, and the year after. Ticks up to 3.6% before eventually settling at 4%. But it's going to be a long time until we get there. Now, take a look at the numbers behind the unemployment rate this time. The number of people in the labor force increases by 418,000. That's the biggest in 2 months. So a lot more people getting out there looking for work. Employment rises by 736,000. This is in the household survey, not the establishment survey. And unemployment falls by 318,000. So more people in, more people finding jobs. That's why the unemployment rate falls. And we used to call that good news. Again, everybody keeping an eye on the overall wages, and the Fed going to worry about a wage price spiral. Taking a quick look at some of the jobs that we got. Leisure and hospitality, 112,000, still growing. Food services and drinking places, 61,000. Professional and business services, 102,000. And retail, 49,000. And we heard some stories about factories not being able to keep up with their orders because they couldn't get enough people. They added 38,000 jobs in March. So broad-based gains, not as large in some categories as we had been seeing, but more categories with large increases in March.
Mike McKee, thank you. Tremendous jobs report, Tom. 431. It's a slight miss on a headline headline number, but look through the rest of the report. Unemployment down to 3.6%, wages climbing higher in a material way, actually, 5.6% year on year. I imagine to kick off an interview with Secretary Walsh, Tom, in about an hour or so, we'll see a happy man down in Washington.
Absolutely. And the social good of the underemployment rate under 7% is there. It was 6.8% was the best pre-pandemic. We're back to 6.9%, just a little bit of a difference there. And on a social statement, which Secretary Walsh is going to focus on, John, yes, it really speaks to a not fully employed America, but certainly the trend is your friend. Our friend on Jobs Day, Jeffrey Rosenberg, joins us, portfolio manager, systemic multi-strategy fund at BlackRock. Jeff Rosenberg, we went curve inversion off of this, now -1 basis points. Let's go back to Carnegie Mellon and talk to me about the nuances and disaggregation of curve inversion. There's zero. There's a little bit inverted. Maybe there's more inversion. What is